Good afternoon, everyone. Brett Wisnowski, Security National Mortgage Company, mortgage loan officer. Today, I would like to start out by saying that this is going to be a longer than usual video. However, it is an important topic, and one of my fellow real estate professionals that I partner with actually suggested this to be the topic this week, and I certainly agree. So, without further ado, we're going to talk about forbearances today. What that may mean for you, what that may mean for your clients if you're a real estate professional, and what, more importantly, you and I can do to help each other. So whether that be me as a lender working with you as a real estate agent to help your clients better understand, or you as a real estate agent working with your clients to help protect their investment. So there's a lot of information out there on forbearances, and I think there's a lot of other misinformation. So today we're going to go over accurate information. And I'm also going to want to discuss just from the two different perspectives what we can do to help your clients or to help you if you yourself are in forbearance. Obviously, most people that have gone into forbearance have some type of financial hardship attached to their forbearance need, and that's likely why they went in forbearance. And I'll also give some real life examples of what I've seen from the lender side in terms of the loan origination, loan process for our clients that were either in forbearance at the time that we spoke to them or were just freshly out of forbearance. So we can certainly look at that as well. So first of all, topic I would like to discuss would be the lender's perspective of what that looks like for helping someone who is in forbearance. In order to provide insight to options that clients may have from the lending standpoint, I would also like to go ahead and start out by discussing a little bit about what's been going on from a macro standpoint when it pertains to mortgage loan originations and servicers' interactions with the investors. So that's your Fannie Mae, Freddie Mac, Ginnie Mae, all of the loan guarantors and investors. So first of all, Fannie Mae and Freddie Mac, and you may already know this. If you're a real estate professional, you probably have already heard this at some point. So any loans delivered to the investor, so they probably would have had to close early October. As of November 1st, if they have not been delivered to Fannie Mae and Freddie Mac, there is something called an adverse market fee that has been added in by Fannie Mae and Freddie Mac. And it's only pertainable to refinances. And essentially what's going on is that Fannie Mae and Freddie Mac are taking this half a point charge that they are collecting from refinance clientele and passing it on to a reserve account. And they're doing so simply because, and this tells me and tells the rest of the world, that they're expecting default rates to go up, delinquency rates to go up, and then also they're using it to stay liquid during a point of time where the guidance, if you will, for mortgage loan servicers is that if a borrower is missing payments due to forbearance, the servicer is now only responsible for the interest-only payments going to the investor. So basically, that's paying the bondholder. And that's actually a great move on their part because the servicers were the ones that were really getting the short end of the stick, especially at the beginning of COVID-19 and the CARES Act. So basically, that was causing problems with servicing premiums and so on and so forth and mortgage-backed securities. So it's a good move that they did that. It is important to know, just so you know, kind of where all the logistics are in terms of the repayment plans. And I'll get to the statistics in a little while, but you'll see why, because from a macro standpoint, there is quite a bit of people in forbearance. So it's important to know where the money flows are going and how this is being compensated for in other ways. So half a point adverse market fee is definitely one way that they're doing it. So that's just Fannie Mae and Freddie Mac. Ginnie Mae, I'll get to them shortly. So in regards to a conventional loan, Fannie Mae and Freddie Mac, the guidance from both Fannie Mae and Freddie Mac is essentially stating that it is up to the servicers, but at the same time, the servicers have to offer you more than one solution. So you have a total of 4 options. And out of those 4 repayment options, depending on what you qualify for or what fits your needs, should be the one that you go with. So I'll go over those now. So option number 1, reinstatement. So reinstatement means that you actually pay the deferred balance all up front in a lump sum. So this works for some borrowers, some other borrowers it may not work for. And again, this is conventional loans, so there's probably a lot of these people that put at least 20% down. That eliminated mortgage insurance, at least in the higher income areas of our housing markets. So anyway, so again, pertaining to repayment plans for conventional loans. So the second of which would be an actual repayment plan. And what that means is it would be a separate balance with a separate payment due every month in parallel with your other mortgage payment. So this, of course, would be a little bit more costly. But if you're in between not having the money and to do the reinstatement and having more excess income where you could do a little bit more, this is actually a good option. So number 3 is a COVID-19 payment deferral. So this is actually specifically for forbearances pertaining to COVID-19, of course. So what this means is it's actually a second lien, if you will, but it's a deferred balance. So you'll continue making your normal mortgage payments, but you'll have this carryover balance that will basically be showing up on your mortgage statement. I've seen real life examples of this a few times, and it just shows up as a deferred balance. And from a mortgage standpoint, and I'll talk about qualification next, this is actually a great option, simply because if you have this option, it's a repayment plan, and you've already gone through with it, and you've made 3 timely payments since coming out of forbearance, then you can qualify for a refinance, and we'll talk about that here shortly, or a purchase, of course. Okay, so option number 4 is going to be loan modification. So you may know the term loan modification from back in the day whenever there was a lot of predatory loans, pre-2008 bubble bursting, so on and so forth. Loan modifications mean that you have to qualify for them, so there's no way around that part. But it can essentially re-amortize your loan. They may mess with the interest rates a little bit. There's a couple different meanings to the term loan modification, and really it's going to be up to the individual servicer how they handle that. So I would certainly ask your servicer if you yourself are in forbearance. But from a standpoint of not doing anything to your loan and basically just working with the servicer, these are your options. And I'll go ahead and list these out on the screen just so you can see those as well. Anyhow, that explains a little bit about what your options may look like with just your servicer. So talking about qualification now. So coming from basically working with your servicer to possibly refinancing your loan and rolling all of these balances in together, there's a couple different options. So first of all, once you're first out of forbearance, if you have any missed payments, so if you hadn't done what's called the reinstatement, option number 1, and paid that off completely, you have to be in a repayment plan. So one of the other 3 options, and you must complete 3 timely payments before the day of closing. So pre-note date is what Fannie Mae's selling guide states. And I've seen several borrowers that have done this. I've seen several borrowers that were only in forbearance for 2 or 3 months and came right back out. And we may have had to wait to close their loans, especially if they were doing refinances, but we were able to at least help them very early on in the COVID-19 pandemic. So anyway, from a qualification standpoint on my side, that would be one thing you would need. Now there is a lot of COVID-19 temporary overlays. A lot of them pertain to income and assets. A lot of them pertain to, of course, forbearance rules. And if you're a self-employed person, you may have been asked for a profit and loss statement for 2020 and year-to-date 2020 if you did it, say before this year, 2021. So that's normal, but there is a lot of overlays that would not necessarily hinder you, but of course something to be aware of if you're trying to refinance your balance. So in the situations where I would suggest refinancing would be that you've started the repayment plan, you're out for 3 months, and it would benefit you to do a rate and term refinance and lower your interest rate, because that would be the building blocks of what we would need. We would need a real good reason to refinance you, and not necessarily a real good one, but we want to make sure we're saving you money. It's for your benefit. If you've maybe done the COVID-19 payment deferral and you have that additional outstanding balance, we can roll that in. We cannot roll in any missed payments unless, again, you have started one of these 4 repayment options. So if you have that particular situation, certainly reach out to me. But that pretty well sums up the Fannie Mae and Freddie Mac version of this. So now I would like to discuss government insured loans. So that's going to be your Ginnie Mae loans such as FHA and VA. Similar to Fannie Mae and Freddie Mac, Ginnie Mae, which is the investor and guarantor of government insured loans such as FHA loans and VA loans, has also adopted their own policy. So Basically both, or I'm sorry, all three, FHA, VA, and USDA, which is rural housing, if you're familiar, all state that the servicer cannot ask for the entire balance in a lump sum. So there's no reinstatement option on these loans, which I think is fantastic. Now, they can't ask for it, but I'm sure as a borrower you can make that payment if you feel most comfortable doing so. So anyway, FHA specifically has something called a COVID-19 standalone partial claim, and what that basically means is that your deferred balance, kind of similarly to a conventional loan for a COVID-19 payment deferral, would be tacked onto the loan as a junior lien, not accruing interest. There's no payment due on it, and it's only due at the time of maturity of the loan or the sale of the property. So I think that's pretty great, and I believe that that's really helpful considering, and I'll show the statistic here a little bit later in the video, that FHA borrowers are the most at risk when it comes to forbearance. So anyway, this is straight off of Ginnie Mae's website. I also have all these materials available, and I'm able to answer questions if you have those as well. I'll likely include a couple of handouts with this video just so you have something to reference. So talking about qualifications, so specifically FHA loans. If you have a borrower that's looking to refinance, if you're looking to refinance yourself, take advantage of these rates. There's a couple of different options if you have been in forbearance. So if you're doing a rate and term refinance that's not a streamline, which there's a difference between those two things, then you would actually have to come out of forbearance and make 3 consecutive payments. However, if you're doing a new credit qualifying streamlined FHA loan, which I certainly recommend. Now, the only downside to this one is that there will be a calculation on how much money you can actually refinance. You may have to bring a little bit to the table depending on how long you've had the loan. So in the case of the new credit qualifying streamlined FHA refinance, you can actually come out of forbearance and still have only made 3 payments or less coming out of forbearance, and you're still able to qualify for that loan. So I think that's quite fantastic. So anyway, that is a look into what Ginnie Mae and government insured loans look like from a forbearance standpoint. Some COVID-19 overlays do apply just like with the conventional loans, and that's any loan that's not just refinances, it's not just purchases, so on and so forth. But I just wanted to give you that piece of information as well from the FHA standpoint. So having gone through those things and having gone through options for clients, from a real estate standpoint, I would like to discuss that. So that will be our next segment, would be what can a real estate agent do for you as a client if you are in forbearance, if you have financial hardship and you don't know your way out of it just yet.